Hey YouTube, what's going on? It's your boy TriniFX here, back with another trading video. Now in this video, I just want to showcase my two trading entry models, which is a continuation model and a reversal. Now let me just start off by saying we don't trade patterns. We are not pattern traders. I'm just showing you what I look for when I'm executing on a 1 minute time frame. So please always start off on a higher time frame, whether it be a daily, 4 hourly, or even an hourly chart, and work our way down. Once we have our direction or bias for the day, then we can concern ourselves about, what entries we're looking for. That's the last thing you should worry yourself about. All right. So looking into this 1 minute time frame, the bias for the day for me at this particular day was actually bullish, right? I had a higher time frame drawn liquidity, which is this green line here. This is a higher time frame buy side liquidity. So what do I actually look for on a 1 minute time frame? So we can see market opened 9:30 and traded down into this hourly fair value gap here. So on all my time frames, I can see higher time frame fair value gaps. So I know exactly where I am in price at any given point in time. So this yellow shaded area is my 1 hour fair value gap. We can see price hit it, respect it, and begin to trade away. Now this is 9:30, it ran lower and began to trade away from it. Keeping in mind that my draw is higher. So what am I waiting for? I'm waiting for price to trade into a 15-minute or a 5-minute bullish fair value gap. Now in this case, price traded into this green shaded area, which is a 15-minute fair value gap. Once price reaches there, so I'm waiting. Price is consolidating, then price drops into my 15-minute time frame fair value gap. And at that point in time, I drop to my 1 minute and I'm seeing what did price do candle by candle. So as price traded down into it and started to consolidate, I'm looking to see what dealing range am I really in. So if I take this low to this high, this is my current dealing range on a 1 minute time frame. So I'm looking for price to drop back down at equilibrium or below. So this here price is in a deep discount and it's also trading back down into a 15-minute fair value gap. So those are the things I look for. Equilibrium lines up perfectly with this 15-minute fair value gap. Now what do I look for? We see price run down, have a small retrace into this 1 minute bearish fair value gap, run lower, and then I'm looking to see where is my market structure shift. Now, guys, for precision entries, every candle tells a story. So price rallied, hit this bearish 1 minute fair value gap and displaced lower. Price could not continue lower and started to consolidate. If we look closely, we see another 1 minute bearish fair value gap form here. So if price was bearish, it should have respected this 1 minute fair value gap and continued to trade lower. So price went up, had a small displacement, but could not break below this 1 minute fair value gap. So this in itself is telling me a story on a lower time frame. Once price rallied into this bearish 1 minute fair value gap and did not displace, I was expecting price to give me a market structure shift, which was here. Why is this my market structure shift? Because to me, I consider this high as my intermediate term high. Price went up, distributed from this fair value gap, and then broke this fair value gap. That's where I look for my market structure shift or shift in market structure. So once price broke above this fair value gap, I took my entry stop below the low, and targeted this level of buy side liquidity. We even had this short-term buy side here on the 1 minute chart. However, I was targeting this higher time frame buy side liquidity. So in this particular trade, it netted a 1 to 2 risk to reward. So this model was my continuation model. Price traded down into fair value gap on a 15-minute time frame. We dropped to the 1 minute time frame and we looked for a shift in market structure to take price back higher. Now we're going to look at my reversal model. And if you notice, I always wait for price to reach either a 15-minute or a 1 hour fair value gap. That's my higher time frame point of interest. So always look for a higher time frame point of interest. In my first example on the continuation model, we waited for price to retrace into a 15-minute bullish fair value gap, then to take price higher. That's on the continuation model. This reversal model, we wait for price to tap into a bearish 15-minute fair value gap, and then we look for a reversal. So as we can see, in the morning before market open, price made a low, consolidated, and at 9:30 we looked to see what price was doing. Price traded lower, could not take out this initial sell side liquidity, and began to run higher. So when I saw this, if price was bearish in the morning, price would have run, take out the low, and displaced higher. To me, this was engineered sell side liquidity being left for a later time in the morning. So when I saw price starting to trade higher, I waited for price to reach my higher time frame fair value gap. Once price tapped into this 15-minute fair value gap, I saw a small displacement. However, there was no shift in market structure, and we're on a 1 minute chart. There was no shift in market structure here. Price then rallied, taking out this initial drop. Once price cleared the liquidity, so everyone who went short here, price cleared it. I was looking to see price come below this intermediate term low here. Why is this an intermediate term low? Price traded in to a 1 minute bullish fair value gap. This took price higher, clearing out this level of buy side liquidity into a 15-minute fair value gap. Once price displaced lower below this low, I considered this my market structure shift. Now what I always like to see is once price traded below and formed a market structure shift, I'm looking to see, this is the dealing range here, I'm looking to see price retrace into at least equilibrium. So I marked off my dealing range high to dealing range low, and 50% lined up perfectly with this 1 minute bearish fair value gap. So once price traded into here, knowing that this was my draw on liquidity, this is where I anticipated price coming to clear out the sell side that was below these relative equal lows. So once price traded back into this 1 minute fair value gap, this is where I took my entry short, placed my stop right above this swing high here that formed this displacement, and I just waited. Price started to displace, run higher one more time. You'll have been in a little drawdown here, but then price ultimately displaced lower, clearing out the sell side liquidity below these lows. So this for me, guys, is what I look for on a 1 minute time frame after having my higher time frame bias, my higher time frame fair value gaps and levels marked off. This is what I look for on a 1 minute or 30-second chart. Now, as I said before, please remember, we do not trade patterns. We must always have a bias in mind. Where is price drawing to? And then we can look for all the details in price action on a lower time frame model, which is this reversal model that I showed you here. So guys, those are the only two models that I look for on a daily basis, whether it's a continuation or a reversal model. And I just wanted to share these models with you all. If you found some value in this video, please consider sharing the video, like, subscribe, and drop a comment. Let me know what models you look for, if this is a model that you trade, and the success that you have found using these two models. Till we talk again, guys, stay safe. Bye-bye.